On June 29, 2026, the Supreme Court handed down two rulings within minutes of each other, both written by the same Chief Justice. In the first, Trump versus Slaughter, the court killed a legal doctrine that had protected independent federal agencies from at-will presidential removal for 91 years, the FTC, and by clear implication most of the so-called independent agencies built like it, are now fully answerable to whoever sits in the Oval Office. Footnote 1. In the second, Trump versus Cook, the same court, the same day, looked at almost the identical legal question applied to the Federal Reserve, and reached the opposite conclusion. Footnote 2. Same court. Same author. Same afternoon. Two completely different answers. That's not a contradiction the justices stumbled into. It's a distinction they drew on purpose, and it's worth sitting with exactly how narrow it is. The Fed didn't survive because the law protecting it is unusually strong. It survived by 5 votes to 4. 1 vote from being exactly as exposed as every other agency the court gutted that same afternoon. This is the story of how that carve-out came to exist, why it held together this year by the thinnest possible margin, and what happens to the rest of the economy if it doesn't hold the next time someone tests it. Start with what most coverage of this gets slightly wrong. The popular version says the Federal Reserve's independence was born in 1951. It wasn't. The actual legal protection at the center of this year's Supreme Court fight is older than that, and the 1951 story is a different kind of event entirely, worth untangling both, because they get conflated constantly. The Federal Reserve Act of 1913 created the basic structure: 12 regional reserve banks and a board of governors, the product of a political compromise between Woodrow Wilson and William Jennings Bryan over how much public accountability a central bank needed. Footnote 3. But the actual legal architecture this year's rulings turned on came later, from the Banking Act of 1935. It removed the Treasury Secretary from the Fed's own board, created the staggered 14-year terms governors still serve today, established the modern Federal Open Market Committee, and, this is the part that matters most, wrote for cause removal protection into statute, explicitly rejecting the alternative of governors serving at the pleasure of the president. Footnote 4. That's the exact 91-year-old statute Lisa Cook just won her case on. 1951 is a different story, and a better one than the independence was born here myth suggests. During World War II, the Fed voluntarily agreed to peg interest rates low to help finance war debt. Not legally required to, just did it, starting in 1942. Footnote 5. By 1950 and into the Korean War, that peg was fueling inflation the Fed wanted to fight and the Truman administration wanted to ignore. Truman met with the Fed's board directly, then told the public they'd pledged to keep supporting his bond policy. They hadn't, or not exactly, and Mariner Eccles, who by then had already been demoted by Truman from Fed chair back down to ordinary governor, leaked the Fed's own internal record of that meeting to the press. The New York Times headline, "Truman is disputed by Reserve Board." Footnote 6. That public embarrassment, not any new law, is what actually forced the March 1951 Accord, a negotiated institutional understanding, not new legislation, separating debt management from monetary policy for good. Footnote 7. Now to 2025 and 2026, where both threads collide. In August 2025, President Trump attempted to remove Fed Governor Lisa Cook, for cause, citing allegations of mortgage fraud that predated her time in office, the first attempted firing of a sitting Fed governor in the institution's 111-year history. Footnote 8. Cook sued immediately. A district court granted a preliminary injunction. The Supreme Court declined an emergency stay that October. Oral argument came in January 2026. The ruling landed June 29. Footnote 2. The court's holding was narrower than a simple win. 5 justices held that Fed for cause protections are constitutional specifically because of the Fed's unique history, and that Cook was entitled to notice and a hearing before removal, which she never received, making her attempted firing, in the court's own words, erroneous and void. Worth noting what the government conceded along the way: it didn't dispute that the Fed specifically needs some form of removal protection, even while arguing, successfully in the companion case, that almost no other agency does. Footnote 9. That companion case is Trump versus Slaughter, decided the same day, 6-3. The court formally overruled Humphrey's Executor versus United States, the 1935 precedent that had protected FTC commissioners and agencies built on the same model, holding that the president now has essentially unrestricted removal authority over most of the independent administrative state. Footnote 1. Justice Gorsuch's concurrence put the stakes plainly: killing Humphreys doesn't cure every constitutional disease in the administrative state. It simply reallocates the power. Footnote 10. And in a detail that closes the loop back to 1951, Jerome Powell, whose term as Fed chair expired this year, didn't leave the board when Kevin Warsh was confirmed as his successor. He stayed on as an ordinary governor, the same move Eccles made 75 years earlier, for what looks like exactly the same reason. Footnote 6. This isn't a purely American story, and one live case abroad is worth treating properly, without turning it into a full accounting of every central bank under pressure. That's a bigger story for another day. Bank Indonesia's governor, Peri Warjio, abruptly resigned on July 27, 2026, citing personal reasons, 2 years before his term was due to end. Footnote 11. The rupiah and Indonesian equities both slid on the announcement. Warjio had been widely viewed as a stabilizing, technocratic hand in an economy already unsettled by President Prabowo Subianto's fiscal agenda. Footnote 12. But personal reasons isn't the full picture here, and this show doesn't need to speculate to say so. A month earlier, in June 2026, Indonesia's parliament passed legislation that explicitly widens Bank Indonesia's growth mandate and gives lawmakers new leverage over its board, including, per financial policy analysts covering the law, a genuine path toward removal. Footnote 13. That's not ambiguous political pressure. That's a documented legal change, weeks before the resignation it preceded. And the succession question carries its own tell. One sitting BI deputy governor is Thomas Jaiwandono, Prabowo's own nephew, and at least one ASEAN market specialist has said openly that his elevation to the top job would be read by investors as exactly what it looks like. Footnote 14. Here's why a single country's case is worth building out fully rather than treating as a footnote. A March 2026 IMF working paper, Boluis, Mano, and Thorel, did something the usual central bank independence research hasn't managed before. Using a hand-coded dataset of 132 central bank governor transitions across 28 advanced and emerging economies since 2000, classified individually as politically motivated or routine based on contemporaneous news coverage, the paper finds that politically motivated transitions are followed by higher and more volatile inflation, both the actual, realized kind and what professional forecasters expect. Footnote 15. There's a sharper, more honest wrinkle in the finding than the simple version of this story usually allows. Growth tends to tick up briefly right after a politically motivated transition, before the inflation cost shows up. In other words, the mechanism doesn't look like immediate damage. It looks like a short-term sugar high with a bill that arrives later, which should sound familiar, since delayed bills are this entire show's premise. One trade publication covering both stories this year, OMFIF, put the connection plainly. Indonesia is the live version of exactly what the IMF's data already shows happens on average across a quarter century of these transitions. Footnote 16. The point isn't that Indonesia proves the American case will go the same way. It's that, does the law actually hold when tested, isn't a hypothetical this show is raising in isolation this year. It's a question with an actual hand-collected evidence base behind it, and a live country-level test running in parallel with the one covered in Section 1. Every door has a locked room behind it. This one is propped open, and everyone in the building knows exactly which door frame is holding it up. Here's the actual shape of the problem, and it's different from anything else covered on this show. The Fed's independence didn't survive this year because it's institutionally unbreakable. It survived by a single vote on a legal theory, unique history, that isn't a bright-line rule so much as 5 justices' judgment call about how much weight a century of precedent deserves. Flip one vote next time on a differently argued case with a differently composed court, and the same reasoning that erased Humphrey's executor for the FTC in the morning could just as easily erase the Fed's exception in the afternoon. The carve-out isn't guaranteed by the Constitution. It's guaranteed by 5 specific people's current view of history, and history as a legal argument is exactly the kind of thing a future court majority can simply decide to weigh differently. That's also why personnel matters as much as doctrine here, which is what makes the Eccles to Powell echo in Section 1 more than a nice historical coincidence. When the legal protection is this thin, The actual defense of the institution ends up depending on individuals willing to occupy the seat and make the fight expensive publicly, the way Eccles did with a leaked memo in 1951 and Cook did with an immediate lawsuit in 2025. The law provides the opening. It doesn't provide the defense on its own. Congress could, in theory, resolve this properly, pass new legislation making Fed independence explicit and unambiguous, immune to being relitigated as a judgment call about history. Nothing stops that procedurally. But doing so would require Congress to spend real political capital defending an unelected institution against a president of its own party, in exactly the kind of fight neither party has shown much appetite for taking on preemptively rather than reactively. The room stays unlocked not because no one has the key, but because using it costs more than anyone currently in Congress wants to pay before the ceiling actually falls in. Step back from the legal mechanics and ask why any of this matters beyond the Fed's own org chart, and the answer connects directly to material this show has already built. Episode 8 covered the mechanism behind America's reserve currency privilege, the structural subsidy the U.S. collects for being the world's default safe asset. That privilege isn't unconditional. It rests in large part on foreign holders of treasuries and dollars trusting that U.S. monetary policy will keep behaving the way it always has, independent of whoever currently occupies the White House, driven by inflation data rather than political convenience. A Federal Reserve whose independence survives by one vote, defended case by case by whichever individual governor is willing to sue, is a genuinely different credibility proposition than a Federal Reserve whose independence nobody seriously questions. Markets don't need the worst-case scenario to actually happen to start pricing in the possibility that it might. A fragile legal foundation can move term premiums and foreign appetite for treasuries well before any governor is actually successfully removed. And this isn't a uniquely American anxiety. Central banks elsewhere are watching this exact fight for what it implies about their own institutional footing, in ways that go well beyond a passing comparison, which is exactly why that's its own story coming next. A single Supreme Court term, 2 rulings, one afternoon. Independent agencies across the federal government lost their insulation from presidential removal, and the Fed kept its own by the narrowest possible margin, on the narrowest possible reasoning, that its history is different enough to matter. Whether different enough survives being tested again isn't a settled question. It's a 5-4 opinion, written by people who can be outvoted by the next case that asks the same thing a little differently. Next time, what the rest of the world's central banks are doing while they watch to see if it holds.